QuickBooks Online 2025 reports for my accountant and reconciliations reports. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. We are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody, looking for the result that has Intuit.com and the URL because Intuit is the owner of QuickBooks. We're going to be choosing the United States version of the software, and we will verify that we're not a robot, so they let us in the door. Let's close that prior tab. It's no longer needed. We're in the sample company file. That's Craig Design and Landscaping Services, opening the major financial statement reports as done every time that go into the reports on the left-hand side. Under the Standards tab, the favorites, right-clicking on that balance sheet to open a link and a new tab. Right-click in the profit and loss, the P&L, the income statement to open a link as well in a new tab. Tabbing to that middle tab, closing the ham boogie so we can change the range. We've been doing that 2-year time frame. 0124 tab 123125. Selecting the drop down, want to see it in years and run it so we can refresh it. That gives us the 24 and 25 years side by side. Let's go to the tab to the right, repeating the process. Hamburger, close that hamburger. 010124 tab 123125 tab, selecting the drop down to see it in years, running to refresh. 24, 25, once again, side by side. Remembering these are the two major financial statement reports. They're not just reports, they're the financial statements. All other reports are usually giving us more information about one or multiple line items of these two major reports. Now we're going to go into those other reports and look at the categories that we have kind of not yet getting into, including the accounting reports. So let's go into the reports section, close up the ham boogie. We looked at the favorites, we looked at the business overview, who owes you, sales and customers, what you owe, expenses and vendors, sales tax, employees, and now we're in the for my accountant type of reports. So now these reports are this category has some duplicate reports because I guess they consider that the financial statements, of course, are going to be types of reports for the accountant. But also, many of the reports here have to deal with more detailed reports, and often those that are using a format of debits and credits instead of the accounting equation. That's kind of how I would define the reports that are in this category. They're typically going to be those that use the building blocks of the financial statements, the debits and the credits, rather than the accounting equation format. Now remember that both of those are two ways to represent the double entry accounting system. So if you were imagining that you're building the double entry accounting system, what would you do? You would enter financial transactions, which QuickBooks does with the data input form, which has an impact on at least 2 accounts, which you can then record typically using debits and credits. They're more efficient. And then by doing that, you would build what we call a trial balance, which is going to be one of the reports here. And that's going to be, in essence, the balance sheet accounts on top of the income statement accounts, but without any subcategories, and the column of debits equaling the column of credits in dollar amount. And then we convert that trial balance into an accounting equation format, the balance sheet and the income statement, the balance sheet being in the format of the accounting equation, assets equal liabilities plus equity, the income statement giving us more detail about, in essence, that equity section. So let's just take a quick overview and then we'll go into some of these reports in more detail in future presentations. So we've got the account list, so just the list of accounts. We've got the recent automatic transactions. So automatic transactions are those that you can make, repeating types of transactions. So that would be a specialty kind of thing. I think we have a future course or section on those if you want to get into them in more detail. Then again, they repeat the balance sheet. We already have the balance sheet. We've seen it in the overview, so they're kind of repeating it here. We've got the balance sheet comparison, which is something that we can typically construct from a standard balance sheet, and both of those are already in the overview, so that's somewhat of a duplicate, as is the statement of cash flows, which is something that we saw in the first section as well, so somewhat of a duplicate. Then we have the general ledger type of report. Now, the general ledger is something that it used to be like if we were at the end of the year and we had to do tax preparation and we have to do possibly financial report preparation with adjusting entries. Then before we can get access, we couldn't used to get access to the software all the time, right? So if you're a bookkeeper and you have to communicate to the CPA firm for taxes and possibly financial statements, you've got to give them the information to do that. So if you have QuickBooks, then typically you can add them as an accountant and then they can generate any of the reports that they need. But if you don't have QuickBooks, or before we had QuickBooks or online software, then typically you had to give them the reports, which would of course include the balance sheet, the income statement, and then they would want to drill down on all of the detail reports, in which case you would give them the general ledger, which gives you the information broken out by date. So nowadays, if you give them QuickBooks and give them access to QuickBooks, then they can typically generate the balance sheet themselves, generate the income statement themselves, and then basically drill down on these reports by basically clicking on it. So when I click on it, we drill down to the report, we get to what we might call a general ledger or GL type of report, but only for that particular account, which is giving me the detail, the building blocks, basically the journal entry, but also the form that constructed it. So that's going to be what we do typically these days, which means if I go back, the typical general ledger is less necessary for just normal small business kind of bookkeeping, because again, you can give access to the full report. Let's just open it up. I'm going to right click and open it just so we can take a look at it. And we'll do some more comparisons with this report and other reports in future presentations. Let's make it for the 02/01/24 to 12/31/24 for the year of 2024. And you can see that it gives me each of the accounts and gives me, in essence, the transaction detail report of it. Here's the balance sheet. If I collapse it, here's the accounts receivable, all the detail in it. So this used to be like if you did auditing or you worked in public accounting, you would be in situations where you had these general ledgers, which were gigantic because of the size of the company and the amount of transactions, and you'd have to kind of go through there to figure out how the financial statements were constructed. Again, these days, way better, because typically you do not have to have an entire paper printout of the general ledger and can go into the reports drilling down on them individually. All right, so then if we go to the next one, the journal, we'll talk more about the journal later, but it's going to give us the detail of the information in journal entry format, even with the data input forms, which is great. Also could be used as a tool possibly for billing purposes, helping you to count the number of accounts that were impacted in a certain time frame, a billing time frame, in which case you might then record your billing based on that. Recurring template list. So this is, a list of the templates. Profit and loss. This is another report that's a standard report that you would expect to be in the overview section as well. It's already there. It's our major financial statement report. So it's redundant to be here. Same with the profit and loss by tags, which can typically be generated from the profit and loss report and is also redundant. Same with the profit and loss comparison. And then we've got the recent transactions. So this might give you the recent transaction information, which could be useful if you're like auditing someone, or you're trying to figure out something's wrong and you want to see what happened recently. And then we have the one we want to focus in on here, which is the reconciliation reports. I'm going to go into that in more detail in a second, but let's just list the rest of them out first. The trial balance. This is an important report and could be very useful, although it's in debit and credit format, because it really gives you a slimmed down view of all the accounts. So if you are comfortable with it, it could allow you to do data input with just the trial balance open instead of the balance sheet and the income statement. Transaction list by account. This is given a similar kind of detailed report as the general ledger. Transaction list by date. This is useful because it gives you all of the detail, but instead of listing it out by account and then by date within the accounts, it lists them out by date. And so we'll talk more about that later. Transaction list with splits. So this gives you the splits, meaning it's going to give you the multiple accounts that are affected if there's more than two. It's in the order of account. However, I wish they had this one like in order by date as well. That's something that I would like to see, but we'll talk more about those in future presentations. Right now, let's talk about the bank reconciliation reports. Note, they call these a report, but they're not really reports. That's what I really want to get into here. All of the reports, almost all of the reports that we talked about here, everything that I would consider to be, in essence, a real report, is something that's going to give us more information about one or multiple line items of the balance sheet and income statement, and are basically constructed at the same time as we build the balance sheet and the income statement. So if I go back to the balance sheet, for example, the classic example is like accounts receivable and accounts payable, which we know that they have a general ledger account, which we call the transaction detail, which we can get by just drilling down on it, and we get the information that created it sorted out by date that it happened. But we also want the subsidiary report. If I go back, the subsidiary ledger report then would take the same information that we used to build this account, but just construct it differently, breaking it out by customer instead of by date of transaction. That's a standard subsidiary ledger account that would simply be constructed at the same point in time as we construct the major financial statements using the same data input tools, in this case, the invoice forms that we input in the pay bills or the pay receive payment forms. But the reconciliation reports are different. So that's why they're not really reports. They're more like internal control type of tools. Why? Because mainly we're talking about the checking account and also the liability accounts for credit cards. What happens with those accounts is we're going to enter them as we have increases or decreases to the checking account. We will construct the checking account in the same way as we just talked about, meaning as we do the data input, we will use those forms to report to the checking account, which will construct, if I drill down on it, in essence, the general ledger type report, which is the transaction report. But I also want to compare this to the bank. Now, the bank is not part of our bookkeeping system. The bank is separate from the bookkeeping system. The bank is kind of like, you can think of it similar like to inventory, where we enter the inventory into the system. The actual physical inventory isn't in our accounting system. Our accounting system reflects the physical inventory if we're using a perpetual inventory system counting by both dollar amount and unit. The actual dollars in the bank is not our accounting system. Our accounting system is accounting for the dollars in the bank. So what we want to do, similar to what we do with inventory, is match up and make sure that what we have in our system matches what's actually the dollars in the bank. And that's going to be a bank reconciliation type of report. So what do? We take we take a point in time, which is the end of the month typically, because that's when we get our bank statements, and we say this is the balance on the bank statement, and this is the balance on our books. If they're the same, great. However, most of the time they won't be the same unless we have a very simple accounting system. So if they're not the same, what do? Is it wrong? Well, no, not necessarily, because it's possible that we recorded something that we knew about that the bank doesn't know about yet, such as outstanding transactions, which were more common and more of a difference when more companies were dealing with checks, because checks take a long time to clear. Therefore, we would reconcile and say, well, this is what the bank has, these are the outstanding items, and this is what we have. And because we can reconcile, that gives us a huge internal control over the checking account. And it gives us an internal control, not just verifying that the checking account is correct, but also that all the transactions in the checking account are correct. And if all the transactions in the checking account are correct, then that means that the other side of the transactions to the checking account, which go through all of the other accounting system, given that the cash is the lifeblood of the accounting system, are at least recorded correctly, if not to the proper account necessarily, which is a huge internal control. So the bank reconciliation is a huge internal control, and the report that we generate from the bank reconciliation is simply reconciling as of a point in time what the bank has at that time versus what we have. Now, these days with bank feeds, that means that some companies might just simply construct their books based on bank feeds. We'll talk more about that later. We touched a little bit on that in the past, but just remember that you can only do that if you have a very simple accounting system, because anytime accrual components come up, it's going to mess up your bank feeds. So anytime you deal with payroll, if you deal with inventory, that's typically going to mess things up. If you deal with accounts receivable, that's going to mess things up. If you deal with accounts payable, that's going to mess things up. And you're going to still end up with these situations where it's possible for you to have a difference from what you recorded to what the bank recorded because of timing differences about what you know versus what the bank knows. And if we can reconcile those differences exactly, we want to do that. It's a huge internal control. So that's going to be the idea. So these reports over here then are different. Like if I go into these reconciliation reports, notice what it did. It bounced me out. It bounced me out to the transaction area. So now I'm in the reconcile area of the transactions. And what we would do, there's no reconciliation reports yet. They don't have any in here. But this is basically where we would go to do the bank reconciliation. And then once the bank reconciliation is done, we would generate those reports. Now, these reports are also important because notice what happens if I say, hey, look, as of 12/31/2024, my bank balance here's the reconciliation of what we have on the books compared to what the bank has on the books. Here's the difference, these outstanding items that we recorded that the bank will record next month because they don't have it yet. What will happen if after I do the bank reconciliation, someone goes in and they delete a transaction? It's going to mess everything up, right? The whole report, the whole reconciliation is going to be messed up now because I will no longer reconcile because now you deleted something that was part of the reconciliation when I had it reconciled exactly before you deleted it. And that's something that doesn't happen with other reports, right? If you went back in and you deleted like an invoice, then that's not something you typically want to do that like without thinking about it. But it would adjust both the subledger account and the accounts receivable account when you delete it, and you'd still at least be in bound, like it still would be reconciled because these things were constructed as we do the data input, whereas the bank reconciliation is not. You're comparing what we did internally in our books to what's happening externally in the bank, and so we'll talk a lot more about the bank reconciliation reports in future courses or presentations on thinking about it directly, when it's easier, when it's more difficult to do, how to set it up and everything. And hopefully if you have a small business, it should be really easy once you get the first one done. But you want to do it. Every business still wants to do it, even if your banks tie out exactly to the bank, your books tie out exactly to the bank because you're using the banks to create your books. You still want to do the bank reconciliation. Why? Because it's possible the bank feeds pull in two transactions, or the bank feeds like didn't pull in some bank feed transactions. It didn't pull them in for whatever reason. You want to be able to see that. How do you see it with the bank reconciliations? Or maybe you see it, but you don't know how to fix it. How do you fix it? You compare your books to the bank books. You do a bank reconciliation. So we'll talk more about those in future presentations, but just remember for now, the bank reconciliation reports kind of support the checking account, but they're not exactly the same as other subsidiary ledger reports because they're internal control type of reports as opposed to reports that are internally created simply from the accounting system.